what's really going on with the economy. Inflation and those big policy decisions, the ones that actually hit your wallet.
Yeah, it's a lot to track.
Exactly. So today we're doing a deep dive, trying to cut through some of that noise. We'll be pulling out the crucial insights from a set of recent financial analyses by Gustavo Acano, all published over at Fund at Mental.
Right. And what we're doing is really connecting the dots for you. We're looking at everything from corporate earnings, inflation data, what the central banks are up to, the bond market.
The whole picture.
Exactly. Trying to give you a comprehensive look at how all these, well, complex pieces fit together right now.
Okay, let's start with the 2Q earnings scorecard. This one looked at the second quarter earnings season. And the surprising thing, maybe, is that U.S. companies, they showed really strong revenue growth.
Strong revenue, okay.
But, and this is key, a lot of that impressive earnings jump wasn't just core business doing great. It was fueled heavily by aggressive stock buybacks.
Ah, so financial engineering playing a big role there.
Seems like it. Communications services and technology were the real powerhouses. I mean, an unprecedented concentration of growth in tech.
Which we've sort of seen as a theme, right?
We have. And what's also fascinating, tariffs. They kept coming up in earnings calls, but this analysis found they seem to have basically no measurable impact on corporate profits.
Okay, that's a really interesting point. If tariffs didn't bite corporate earnings, where are they showing up? How are they affecting the wider economy and, your wallet?
Good question.
Our next source, CPI in a tariff world, actually dives right into that. It was looking ahead to the July CPI report, that's the Consumer Price Index, measuring what you pay for stuff.
Right, the inflation number everyone watches.
Exactly. And the key insight here was that if that CPI number hit or went above 2.8% year over year, it would kind of back up Jay Powell's stance at the Fed.
To keep rates where they are.
Precisely, to hold steady. The analysis stressed looking closely at goods inflation specifically to really see the tariff impact on consumers. And it also flagged that a jump in the PPI, the Producer Price Index,
which can hint at future consumer prices.
You got it. A jump there would likely push U.S. Treasury yields higher.
Okay, so that's the U.S. picture. But if we look at dovish world, this source paints a really perplexing picture for central banks globally.
How so?
Well, it points out that most central banks outside the U.S. are actually cutting interest rates. Think the Bank of England, Mexico, driven by this belief that inflation is basically under control.
Okay, so they think they've tamed it.
That's the rationale given. But here's the puzzle. If tariffs are supposedly paid by exporters into the U.S., why are their central banks cutting rates? Is it really just about tamed inflation?
Or is something else going on?
Right. Or is it maybe weak global growth pushing these cuts? Could it even hint at, stagflation for developed economies, low growth, sticky inflation?
That's the core tension, isn't it? And that brings us neatly to inconclusive, which really tries to unpack these conflicting signals.
Yeah, inconclusive feels like the right word sometimes.
It does. So the June inflation report itself, pretty mixed. The main number met expectations, but that core inflation, stripping out food and energy, was stubbornly higher than expected.
Still sticky.
Very sticky. Interestingly, the White House kind of spun this as a win, arguing, see, tariffs aren't an issue for goods inflation. Yet the Fed, especially Jay Powell, seems to hold a different view. They seem to anticipate inflation picking up because of tariffs, and they want more solid evidence before changing policy.
So a standoff almost.
You could say that.
Yeah.
And this analysis really highlights the huge political pressure on Powell to cut rates significantly. Meanwhile, the bond market is kind of the ultimate judge in this whole inflation tug-of-war.
Okay, and this leads us straight into recalculating, because here, the U.S. Producer Price Index, the PPI for July, it came in hotter than expected.
Right, adding more fuel to the fire.
Yeah, exactly. It reignited that whole debate. Do tariffs really cause inflation or not? The key takeaway seems to be that core inflation metrics, PCE, PPI, CPI, they're all kind of stuck, stubbornly hovering around 3%, which is way off the 2% norm we had for years.
And that hits people directly.
Absolutely hits your wallet. Wages haven't really kept pace for many, forcing people to use credit cards more just to bridge the gap.
Which then fuels the political pressure for lower rates.
Intense pressure. Yet, and this is wild, despite this hotter PPI data, the market's belief in a September rate cut stayed incredibly high, like rock solid.
It's almost like the market just decided, isn't it? Regardless of the incoming data.
Pretty much.
Yeah, and that market conviction is absolutely central to the next piece, repricing. This one shows an astonishing shift. The odds for a September rate cut by the FOMC-SC, The Fed's committee went from just over 50-50,
Which is basically a coin toss.
right, to an almost certain 99.9% chance of a quarter-point cut. It's baked in. The Treasury Secretary is even pushing for a bigger cut than that. And the bond market seems to agree, signaling multiple cuts ahead, with Treasury yields falling. It essentially shows the market doubling down on the idea that tariffs aren't inflationary and that actually monetary stimulus is exactly what the economy needs right now.
Okay, so the market's betting big on cuts. But finally, let's look at short. This tackles the elephant in the room, that massive government deficit.
Yeah, how does that fit in?
Well, this source highlights that one-off things like tariffs or maybe revaluing gold reserves, they just won't close that huge annual gap between what the government spends and what it takes in.
Not even close, I imagine.
Not even close. The big hope, it seems, is that artificial intelligence, AI, will boost U.S. GDP so much it eventually dwarfs the deficit.
The AI magic bullet.
Kind of. But the analysis suggests that even with the hyperscalers, those giant tech companies investing huge amounts, AI's short-term impact probably won't even cover that investment over the next few years.
So a payoff down the road, maybe?
It seems inevitable long-term, yes. But the crucial question is, who or what bridges this financial gap in the meantime?
A very big question.
So wrapping this up, what does all this actually mean for your financial reality? We've seen this fascinating, often contradictory dance. You've got economic data, central bank caution, political pressures, all impacting consumers directly.
Right, from earnings boosted by buybacks, not just business, to really complex inflation signals.
And this near certainty in the market about rate cuts, even with these ongoing debates about tariffs and, frankly, how we're going to finance the government.
Yeah, exactly. And that leads to the final thought, maybe. Given this strong market conviction for rate cuts, even while inflation debates are still hot and we face these big government financing challenges, what does that truly signal about where our economy might be heading?
And maybe more importantly,
what could the long-term implications be for your financial well-being as all these powerful forces keep playing out? Something to think about.